Hello everybody and welcome back to another microeconomics video lecture. So last time we talked about our profit maximizing rule, right? Our golden rule in economics, where to optimize or maximize our profit, we are going to produce Q star wherever the marginal revenue is equal to the marginal cost. We did an example of that using the raspberry farm and the raspberry industry, which hopefully makes sense. And now we're going to talk about, are these firms actually making an economic profit, right? Remember we had that definition of economic and accounting profits, right, at the beginning of chapter 7. So the important bit to remember is that economic profit includes your implicit costs, right? So your foregone wages, your foregone interest, depreciation on capital assets, so on and so forth, right? So the question is, does producing Q star where the marginal revenue is equal to our marginal cost, does that actually imply an economic profit? And the answer it depends. That's always the answer with economists, right? So it depends. Depending on what? On the relationship between price and the average total cost. So we talked before about how the average profit is defined as whatever that equilibrium price is minus the average total cost, right? And this can also be described as the profit margin. So just like margins in your paper, right? Usually 1 inch is all around. It's the space in between the end of the paper and the beginning of where your text is. Similarly here, it's the space between where the equilibrium price is and where the average total cost curve is. So let's go ahead and talk a little bit about what it looks like for firms to be making a economic profit, right? So let's just kind of keep it simple and talk first about a actual positive profit. So a positive economic profit is going to have a price that is associated with the equilibrium quantity for the particular firm that is above the average total cost curve. So in order to figure all this out, we need to include our average total cost curve. And then we'd want to include our marginal cost curve, our Nike swoosh. And then because we are given the price, right, it's a market price, we're price takers, our price is going to be equal to our demand curve, which is going to be equal to our marginal revenue curve. And so using that optimal decision, right, our profit maximizing rule, that we want to produce Q star where our marginal revenue is equal to our marginal cost. So that means that we're going to find where they meet. We're going to drop an anchor down. That's going to be my Q star. And now at this particular quantity, we want to look at what the average total cost is for this firm. And so the average total cost is below the price. And so as a result, this whole rectangle here, this whole shaded rectangle here, is going to be equal to our profit margin. Well, let's not call it profit margin. Let's just say economic profit or positive economic profit. Now, one of the characteristics that happens in perfectly competitive markets is that because there's free information, everybody has free information about, how much other people are making, right? So you can't hide your profits, right? People are going to know that you're making positive economic profit. And the other bits of information that we know about perfectly competitive market structure is that there's free entry and exit, right? There's no barriers to exit. So if we go back to our supply and demand graph and we go ahead and say, well, here's the demand and here's the supply, that's what creates this equilibrium price over here, right? So now we're going to start talking about the dynamics of what happens after firms realize their positive economic profits, right? So again, this information is available to everybody. It's available to other sellers. It's available to sellers that may be able to switch into producing whatever good you're producing. So in the long run, right, this positive economic profit is going to be eroded by what? By a shift outwards in the supply curve. And the reason why there's a shift outwards in the supply curve is because the number of sellers, one of our determinants of supply, right? The number of sellers has increased. And the reason why the number of sellers increases is because there's positive economic profit, there's free information, and there's free entry and exit. But what is this going to do to the equilibrium price? This is going to lower the equilibrium price until it is down here. And so what ends up happening is that our So what ends up happening is that this marginal, here we could do this. Perhaps we could. This marginal revenue curve is going to move downwards, right? This is going to move downwards to wherever the new price is. And we're going to now produce where the marginal revenue equals the marginal cost. So Q2 star. And here we find that we're pretty much right on top of that. Actually, we're not terribly on. No, so the average total cost is right here. And so at this point, our profit rectangle has decreased to this tiny little thing, this tiny long thing. And it used to be this big gray thing, right? So essentially, the fact that you're making your profits, the fact that there's free information, the fact that there's free entry and exit is going to cause the dynamics of more sellers entering the market, which is going to erode your profit by having some downward pressure on prices, right? This is our P1 star. This is our P2 star associated after that supply change. Now, let's talk about the situation of what if there was an overreaction of the sellers, right? Let's talk about that real quick, just to help illuminate some things. All right, so let's say, again, we start off with some positive economic profit price, right? Some price that's way up here. And let's say that there's a shift outwards of the supply curve that's a real extreme shift outwards. So the new supply curve is down here. And let's say that we have very similar average total cost and marginal cost curves as before. Well, at this new price down here, right, this P2 star, if we go ahead and reflect that onto the individual firm's graph, what happens? There's been so much pressure on the price that if we use our optimal, if we use our profit maximizing rule, right, which is to produce Q star where MR is equal to MC, if we're going to use that, well, then we have to find where they meet and go ahead and drop that Q star like an anchor. And now we need to find the associated average cost with this Q star, right? And normally we're used to, looking underneath the price, which is also our demand, which is also our marginal revenue curve. But in this circumstance, there's been such an overreaction that as a result, there's going to be average total costs higher than the equilibrium price. And this whole area here, maybe we'll use a different color shade for this. This whole area here is going to be, I guess I should have used red or something, but whatever. It's going to be a negative economic profit, right? Or otherwise known as a economic loss. So whenever the price is above the average total cost curve at our profit maximizing quantity, if the price is above the average total cost, you are making a profit, abnormally large economic profit. If the price is below, you're making a economic loss or negative economic profit. Now, what is going to happen in the long run? Well, in the long run, there's going to be some adjustment of supply, but essentially this supply is going to adjust until it gets to, let me just go ahead and, so that, they're going to come in and say, oh man, I'm making a loss here. So what's going to happen? Well, some of these people are going to leave the market. They're going to leave the industry, right? They're going to go back to selling what they were selling before, or they're going to jump to some new cash crop, or whatever the case may be, right? And the price is going to go up only until, and this is our long run equilibrium here, it's right at the bottom of the average total cost curve, and it's exactly where the marginal revenue curve intersects the average total cost curve, because again, by definition, the marginal cost curve always crosses through the average total cost curve at its lowest minimum point. So where these three things intersect, this is our long run equilibrium. Right? In the long run, these firms are going to have zero economic profits. Now, what does it mean to have zero economic profits, right? So zero economic profits, remember, translates to positive accounting profit. So when you're making a zero economic profit, you are recouping all of that opportunity cost of your time, of your capital, of your property, so on and so forth, right? So we have to remember that even though this seems like not that interesting of a point or not that great of a place to get to, right? Like, why would you want to operate making zero profit? It's zero economic profits, not zero accounting profits, right? So you're still throwing up positive numbers in terms of the actual books, but you're probably making what, $80,000 to $200,000, just depending on what your opportunity cost of your time is, and also what the foregone interest is on the capital that you invested into the business. All right, well, I think you guys should be all set now between this and your reading to do the take-home exercise. It's just 5 quick little short answers. So if you have any questions on that, please go ahead and email me or leave a comment down below. And if you have any questions on any part of the rest of the chapter, just go ahead and shoot me an email. Thanks so much. Have a great day.